Good afternoon, good morning, and good evening, everyone. I'm Maria Lombardo. I'm very pleased to present our webinar, Transition Intelligence in Practice, organized by SAP Pioneer and Asset Impact. I'm Maria. I am the Senior Advisor of Asset Impact. I'm the founder and the CEO of Rose Global, which is an advisory company in sustainable finance. And today I have the pleasure to moderate this webinar. Let me start with the agenda. Today we are going to have 4 sessions. So the first session will be a presentation by Stéphane Malchau and Michel Amar. We then pass on a presentation from Asset Impact, Alex Clark, and then we will have a demo from Fatima Vargas. At the end of it, we will be having a Q&A, but I will encourage everyone to put your questions in the chat that you find on the right-hand side of your screen, and then we will try to answer to all your queries. Let me introduce Stéphane and Michel first. Stéphane.
Yes, hi everyone. Stefan Malchow, I'm part of the SAP Pioneer team of the ESG solution responsible for sales. And with me today, also from the Pioneer side, is Fatima Vargas, a product manager of the ESG KPI engine. Over to you, Michel.
Hi everyone. I'm Michel Amar. I'm leading the business development at Asset Impact. So I'm working with our clients on the use of our products or data sets and helping them on their journey towards the decarbonization of their portfolios. And today I'm here also with my colleague Alex Clark, who is our research director, and will be presenting Asset Impact a bit further.
Thank you, Stéphane and Michel. So let me start to set a little bit of the scene on this part that we're going to present on the evolving needs for net zero and the portfolio strategy and transition planning. When we talk about financial institutions, we know that they are under a continued pressure to continue to steer their portfolio towards zero. But most of them do lack what we call the transition intelligence to do so effectively. And we see the pressure that is coming from the regulators, the pressure that is coming from stakeholder, and in here, not just we have some of the initiatives, the target setting that most of the banks have already set up and need to comply to, but also we have all the opportunity side on the transition finance. So what does it mean using data and being credible and being able to embed this into the strategy? So let me start with asking Michel, what do you see in this environment being the major challenges that banks are facing when they are establishing their portfolio decarbonization strategies?
Yeah, thank you, Maria, for the question. I think it's an important question and probably very relevant to the attendees. So I would say in terms of the challenges for managing the portfolio decarbonization of financial institutions, and I think with a focus especially on the banks, there are probably 2 big categories. The first one is regarding the internal challenges, and in terms of internal challenges, you have a big element of governance as well, how well sustainability and climate is integrated into the bank's departments and policies. You have also a big struggle around data and systems, which I will deep dive into a bit later, and also on how to identify and banking green projects. And then you have also external challenges, which you just mentioned in the introduction, which are related to external pressure from stakeholders, a changing regulatory landscape, and which especially these days is very difficult to follow and creates a lot of uncertainty. Here on the slide that you see now, I focus on the top 5 challenges regarding especially data and systems, because this is where this partnership between Asset Impact and SAP Pioneer can really bring the most value. And in terms of data and challenge, I would say I would list really 5 things which are coming back again, with every client or potential client we've been talking to. The first one is, of course, the availability of data and of quality data. And what we mean by quality data is, I would say, first, data which is reliable. That means that, of course, every bank is also receiving and using corporate disclosures from their client, but it's usually not enough, because corporate disclosures, they tend to be inconsistent in methodologies, not always showing the same level of transparency, and still missing for some companies, and I'm thinking about private companies and SMEs, etc. So the banks, they also need to rely on independent providers, which are trustworthy, which are scientifically based, and which could also prevent them from being accused of greenwashing. So yeah, they need reliable data. They also need timely data, which means that they cannot take action on data which is being calculated 2 years ago, disclosed 1 year ago, and then finally getting in the hands of the bank. So they need something which is refreshed more frequently, which is reflecting the accurate data from the companies today. And this is also a challenge we hear a lot. And the third thing about quality data is also data which is actionable. That means that the banks have usually defined climate metrics to steer on. Often what we see is they use a sectoral approach where they want to use physical intensities to actually decarbonize their portfolio, and they need to be able to steer at that level. That means they need to have insights on the technologies which are being used by companies and leading to these metrics, and sometimes even being able to get down to the physical asset level to know the location of these metrics, and again, where they need to actually take action. And this is not necessarily available out there, and they're struggling to get there. So really, I think quality and availability of data is one key challenge, which I spend a little bit of time on because it's really central. Then in terms of mapping to their portfolio, once they get the data, they need to be able to map it to the portfolio, which means they need to be able to allocate the exposure and the climate metric at the level where they actually where the lending happens. And it's not always at the group level, but sometimes at subsidiary level, and they need to be able to consolidate and allocate. And there are here issues with accessible identifiers, being able to also consolidate different data providers which are not using the same methodology. So consistency is also a challenge here. Then in terms of the number 3 and number 4, I would put them a little bit together, which is that most of the time the processes, the workflows, the systems, and especially the data management systems in the banks have been created for financial data, which is very mature and has been around for a very long time, while climate data is a bit of a new field, relatively new field. Mm-hmm. And these systems are not always built to handle non-financial data, and that means that there are still a lot of manual processes, Excel spreadsheets flying around, and that's causing issues in terms of auditability, in terms of tracking year-on-year changes, volatility between one reporting year and the next, and clearly something which we hear a lot. And I will finish with the fifth one, which I think is fundamental, is how to move from reporting to taking action. And that means that it's not just about calculating where you are, calculating your current baseline, but it's also being able to integrate the climate objectives of the organization in every system, from the sustainability team, but also in the risk management systems and in the front office system, so that can actually influence credit decisions and allocation of capital. So I think this end-to-end integration is something which is where we see a lot of banks currently struggling.
Thank you, Michel. And taking on from your fifth point, in fact, and when we move on the technology, Stéphane, how do you really see these the way that banks effectively move forward from reporting to active managing their portfolio?
Yeah, thanks, Maria, and thank you, Michel. I think this is very much a trend that we're seeing, like already in the past year, but also looking forward in 2026. That the focus is really shifting from I have to measure where I stand today to also getting a better and better understanding of how can you actually take action and get better visibility in terms of how to decarbonize the book and really steer and actively manage the portfolio towards interim targets in 2050, but then also an ultimate net zero goal at 2050. Three key pillars that we see here. The first one is starting to move from top-down data towards using more and more bottom-up data. To unpack that a little bit, top-down data means that you're essentially using industry-level proxies and country-level proxies, and you would be treating two companies that operate in the same sector in the same country, you would treat them in the exact same way. So effectively, you could be continuing to finance the highest emitters in a particular sector, and if only using top-down data, you would treat them in the same way, and you could essentially continue to finance the highest emitters in a particular sector, and nobody would notice it, right? In addition to that, top-down data is really not decision useful at the individual customer level. And that's why it's so important that we start collecting more and more bottom-up data. What we mean by bottom-up data, that's on the one hand, of course, what we are looking at traditionally, i.e. collecting reported data directly from the counterparties. But it can also mean that you start collecting actual bottom-up asset level data of those companies, so the assets that belong to the companies, and then looking at the underlying production volumes, the emissions intensities of those assets, and the emission profile of those assets. And I think this actually becomes increasingly important, or will stay super relevant for quite a long time, because what we see is that geographies are moving at a different pace, and also CSRD has slightly fewer companies in scope as we had all originally expected. So that's the first piece. The second piece is around moving from using backward-looking data to starting to move towards using more and more forward-looking data. And I would say that that one's already actually quite advanced. But an example that I like to give here is that I used to work as a credit analyst. And when you look at analyzing financials of a company, then it's very common that you look at past performance. So you would typically look at the past 3 years, a couple of key KPIs, and then you kind of assume that the future performance is going to be very similar to the past performance. So in other words, past performance for financials is often a very good indicator for future performance. Now, and that's true in most years, maybe not when COVID is one of those years. Now, the thing is, for climate performance, it's, in some sectors that might be the case, but in a lot of instances, it's very unlikely that past performance is a good indicator of future performance. And that's pretty much irrespective of which temperature pathway we end up on. So if you say you look at a particular company in one sector, then today they might have an emissions intensity that is above the sector average, right? That is above the decarbonization pathway that they should be on. But then they might actually have a target in place. They might have a credible transition plan in place. They might have clearly defined decarbonization levers. And once you start taking that more forward-looking perspective, then you might actually form a perspective where you think, okay, that company is actually on track to, by the year 2030, for example, being be below the benchmark for their sector, for example. So starting to look at those forward-looking indicators, such as transition plans, such as asset level forecasts, and so on, can really make a difference in terms of getting superior insight for the individual companies. And then the third one is around moving from portfolio level steering towards more customer level steering. On that part, I would say we've become really strong at measuring the net zero, the point in time net zero alignment of the portfolio. That is based on typically historical data. It's often a manual exercise, and it's kind of done, maybe once per year. But really, from here, we have to start to move more and more towards an ongoing assessment of the transition alignment of the portfolio, and we have to start going much more granular. That is really looking at the individual companies and ultimately starting to integrate, climate assessments already at the origination stage in the front of the systems when you look at assessing new credits. So those are some of the, I would say, key levers that we are seeing in terms of really how to improve ways of managing decarbonization of the book.
Thank you very much, Stefan. So going more and more sophisticated from a static situation into a more dynamic situation, but with more quality data to try to overcome the challenges that we see with data that offer a bottom-up approach, so going more into dissecting and making it more relevant locally or for industries specific or asset level, going into more forward-looking, so not just looking at the the year before, but actually looking into the future and the impact of the different scenarios there, and then more customization. But so this is part of all the intelligence. So, but how do we really do this intelligence and asset level transition intelligence? So I would like to introduce here Alex Clark and his considerations. Alex, over to you.
Thank you very much, Maria. So as Michelle mentioned earlier, I'm Alex Clark. I'm Head of Research at Asset Impact. And over the next few minutes, I'll give you a whistle-stop tour of what Asset Impact's data is and how it's put together with a sprinkling of examples showing how our data is put to use. So what Asset Impact does in a nutshell is provides production and emissions indicators built from the asset level upwards in 4 stages. In the first stage, we collect information on producing assets in high emitting sectors in the real economy all over the world. We model their emissions, and then we build emissions and productions forecasts on top of those. In stage 2, we transform a collection of data on individual assets into a map of a lending or equity portfolio by linking assets to their direct owners, the indirect owners, and their ultimate parents, and then we consolidate production and emissions metrics to the company level. Our analytics layer, which is stage 3, overlays all sorts of useful derived metrics on top of this, which include company performance against IEA scenarios, for example, ready-to-go financed emissions data, and data pre-formatted for use in the PACTA tool. Finally, in stage 4, we help our clients in the financial industry integrate our data into their portfolios by mapping each company to NACE codes, ISINs, LEIs, and other types of identifier. We're often asked where our data comes from. So we start by collecting millions of data points on individual assets from a wide range of sources. These go from open sources to governmental sources to commercial data sets and also internal research. From there, we apply emissions models consistently across all of these assets using our in-house models, which results in comparable indicators across roughly 300,000 assets across now 13 emissions-intensive sectors. These are spread across 3 tranches of the global economy: energy, transport, and industry. And in every case, our coverage is global, and in almost every sector, we cover over 95% of total production. So our energy coverage includes power, oil and gas, and coal mining. Our transport coverage includes shipping, aviation, and automotive. And industry covers cement, steel, aluminium, and most recently, chemicals. We're also often asked how we get from asset level to company level in a reliable way. The first element of this is straightforward. We identify who owns which assets and in which proportions, both directly and indirectly. We then consolidate those indicators up the ownership tree in several different ways to give our clients as much flexibility as possible in their analysis. And we can consolidate indicators to any company based on the assets it owns directly or those it owns indirectly, either weighted by equity share or on the basis of financial control over the underlying asset. This, in turn, results in about 73,000 companies covered, the vast majority of which are either private or unlisted subsidiaries of listed parents, which themselves make up about 3,000 to 4,000 companies. These are then mapped to 172,000 securities across equity and fixed income, representing 3/4 of global emissions. Bringing it all together, and you have the data sets powering our partnership with SAP Pioneer. Company-level activity and emissions indicators, both intensities and absolute, all broken down by scope, by sector, technology, year, company, and asset location to give you the right balance of flexibility and structure. Each company is linked to identifiers associated with country of domicile and a company type, with flags for ultimate parent companies to help users identify the top of every ownership tree. And our proprietary forecasting models also project indicators forward. So this gives you a clear and transparent insight into the possible evolution of each company's underlying asset portfolio and its associated emissions, and perhaps more importantly, decarbonization levers. In addition to the company level consolidations, we're also able to offer asset level data across 9 sectors, soon increasing to 11. With each fixed asset geolocated, this facilitates geospatial overlays for things like physical risk, biodiversity, nature risk, and many other applications. And what's more, at this level of granularity, users can access asset level activity and capacity data, absolute emissions and emissions intensities, as well as links to direct and ultimate owners with corresponding identifiers as well. I'd like to briefly look at what our data can do in practice. So using our own data, we analysed the German utility RWE, and we took a critical look at its decarbonisation plan and whether it's on target to reach its 2030 emissions goal. RWE relies on coal retirement and renewables ramp up for about 40% of its planned emissions reductions. But interestingly, another 20% are based on carbon capture and clean fuel blending, both of which are explicitly conditional on policy developments. They contribute less to the overall target, but they're also more conditional and better characterized as ambition than planned reductions. And then perhaps most alarmingly, for another 40% or so, there appears to be no plan at all at present. We conducted a similar exercise for another German utility, EnBW, and we found some similarities, but also important differences. EnBW relies much more on retirements, but it also relies on asset sales, which shift emissions rather than eliminating them, and by a factor of 3 compared to RWE, fuel blending. On top of this, only 30% of its emissions are covered by commitments and 20% have no plan at all. So this sort of detailed analysis of transition plan credibility and dynamics is what's made possible precisely by our asset-based approach. With asset impacts data, you don't need to take companies' commitments at face value, and you can interrogate, understand, and test them against the underlying assets. We work with some of the biggest names in banking and sustainability data across the world, and in many cases, we've done so for several years. So what we've seen is a rapid evolution of use cases from the bare essentials of measuring a baseline in the form of financed emissions in most cases, to setting sectoral decarbonisation and financing targets, conducting portfolio steering processes, and guiding robust engagement with clients. The advantages of our data for accounting exercises extend across comprehensiveness, comparability, private and public company coverage, as I referred to earlier, and geographical coverage. But as I demonstrated with the utility case studies, the structure of our data also facilitates a detailed understanding of transition risk and green capex today and in the future, as well as rigorous benchmarking against externally validated scenarios, as well as industry peers. So as their loan book evolves, our clients can actually interrogate and build their own forecasts. They can separate leaders from laggards, set screening or exclusion criteria with ease, and originate new business. And finally, the detailed and independent breakdowns available from our data allow financial institutions to engage with their clients in a much more detailed manner than would otherwise be possible, all the way down to asset retirement dates, technology deployment, and stress testing of future trajectories. ING's Terra tool does exactly this. So asset impacts data feeds into its internal climate alignment dashboard, which is used for reporting, but also for portfolio management and compliance. On the horizon for ING is the building out and testing of client-level transition plans validated against asset-level data and used to fuel the meaningful engagement that underpins ING's own transition strategy as a bank. And finally, the European Central Bank has also been using our data in its own stress testing and regulatory exercises. In a report from last year, it married asset impacts data with AnaCredit loan portfolio data to assess the Paris alignment of about 3/4 of euro area lending. And it also recommended that banks use this detailed approach to determine the transition risks they face, as well as to meet parts of their EBA Pillar 3 disclosure requirements, which include physical emissions intensities. So with that, I'll hand back to our colleagues at SAP Fioneer to demonstrate how by joining forces, we're bringing together asset level insights and risk and finance workflows together to generate the sort of advanced decision-ready transition intelligent insights that the financial industry needs. Thank you.
Yeah, many thanks, Alex. So we now want to take a closer look at SAP Fioneer and our ESG KPI engine and how we leverage asset impact data for the calculation of financed emissions, for the calculation of net zero alignment, and actually deriving insights for your portfolio of how to decarbonize the book. So to jump into that, and we'll actually show you a demo of the product in just a second. But just to take a step back for a moment, why we're actually partnering. So essentially, we are seeing an increasing need of banks to really start embedding climate performance in both the finance world as well as the risk world, as well as the front office as well. And financial institutions more and more don't just want to do this as a kind of like standardized siloed process, but it should really be part of the core processes and the core systems. So that's where SAP Finance comes into play. But then the challenge is that really the embedding only becomes actually powerful depending on how good the data is that you're using. And that's where asset impact data comes into play, where we get that incredible amount of granularity on the asset level with the bottom-up data, as well as forward-looking indicators. So what we do together in our solution is that we help banks enrich their own portfolio data with the asset level insight provided by asset impact. And how that works in kind of like 3 steps outlined on the upper half of the slide here. It starts with the configuration that is all around data management and essentially having the ability to orchestrate data from multiple different sources. For banks, that's always on the one hand bank internal data, portfolio data on your loan book, but then also external data, not just from asset impact, but typically also from a variety of other external sources. Then it comes to the calculate part. That is where we are calculating the finance emissions as well as the net zero alignment. I'm always doing that at the maximum level of granularity. That is going down to the individual business partners that you're financing, the underlying activities, the underlying assets, and then attributing that to the individual financial products, i.e. the loans that are financing those companies. And then the last aspect is the control aspect. That's all around reporting and generating insights for decarbonization, for steering, as well as for decision making, also when it comes to new credits. So with that, let's just move on. In terms of what does the end-to-end flow look like for managing finance emissions, that always starts, as just said, with the loading of financial key attribute as well as non-financial data. So it's always a combination of sources. Then, depending on if you have already set net zero targets or not, in the KPI engine, you can configure your own net zero targets. That is on a sectorial basis, and it can be both internal as well as external targets. We then go into the calculation of the actuals, that is looking at the finance emissions, the absolute emissions at the asset level, but also the company level, and then comparing that against the respective targets. Once that is done, you can take a look at the dashboards for reporting purposes, for ongoing monitoring, and ultimately through the integration with front office systems, also for the assessments of new credits. So Fatima is going to walk you through some of those steps now as part of the live demo of the KPI engine. So with that, I'll hand it to you, Fatima.
Okay, thank you, Stefan, and thank you everyone for joining. So today I want to give you a quick overview on how the Pioneer ESG KPI engine can help you steer your bank portfolio towards net zero. So for that, I will walk you through 2 of our use cases. So first of all, with finance emissions, and then we can go through net zero. So these are 2 use cases that we currently have, and they build on top of each other. So first, in regards to the finance emission use case, what you are seeing here is our overview page. So here we have some sample data on how a finance emission calculation would look like for your bank portfolio. So as you can see, we actually follow the PCAF standard, and we calculate finance emissions based on different asset classes. So according to the PCAF definition of the different asset classes. So as you can see, we calculate business loans and unlisted equity, commercial real estate, mortgages, and so on. And these calculations are also done across different data quality scores. Now, in case you are not familiar with the PCAF standard, these data quality scores, it's actually it reflects the level of accuracy on how the emissions are calculated. So from score 1, which is the highest level of accuracy, to score 5. Now, this is actually quite important because our solution actually always tries to calculate the best data quality score based on the data that you have available. Now, here, for example, we have a feature which is called the data hierarchy or hierarchy manager, where you can see that you can actually input different data from different sources. So it's important to note that even though we have a partnership with Asset Impact, our solution is data agnostic. So we can actually work with different data providers, and the data that you add here will be used for the calculation of the finance emissions. So for example, here, if we look at company data or business partner data in this case, we can have data coming from different sources. But then you have the ability to rank these sources. So for example, in this case, I have ranked asset impact data as level 1. So that means, okay, even if you have data for the same company from another provider, the solution will always follow this ranking. So it will take the hierarchy that you define here, and this is actually applied across all of the data quality scores that we viewed here. So once we have this hierarchy defined, then our engine will actually calculate the finance emissions based on the different methodologies that we have with PCAF. And something quite interesting to notice, even though in the data hierarchy it might be a bit complicated and you might have a lot of different data sources, our solution always makes sure that all of the results are audit proof. So that means we actually offer an insights section here where you can actually have different views of the data. So you can have a look depending on the business partner or the company that you are running the calculations for. You can also have a look at the different physical assets. So this is applicable, for example, for finance emissions calculations, for motor vehicles or for buildings. So you can look at that data granular here. And we also have one so-called single exposure view where you can see all of the summarized data. So what it does is it actually gives you a full overview on which emission factors were used for the calculation, which data sources were used for the calculation, and all of the different values that were taken to calculate your finance emissions. So all in all, it helps you have like an audit proof and trace back how the calculations were conducted. Now, that is in regards to the finance emissions model. Very high level, of course. We have a lot of very specific rules, but unfortunately, we don't really have the time to go through those right now. However, this view, so once we have a consolidated view of your finance emissions, then we can say, okay, you already measured your portfolio, so you know which emissions you are financing. Now the next step is to know, to start steering your portfolio towards net zero or create different targets. So this is our second part, which is where you can actually customize your net zero targets. So as you can see here, I have some sample data, but this is very flexible. So let's say you come here and you want to create some targets or monitor one sector in your portfolio. So here you can actually define which sector you want to start tracking and monitor. And for example, here we have one example of a high emitting sector, which is steel, and we have different levels. So for example, you can set up a target for steel, but defining which type of methodology was used in the production of steel. So here you can define, okay, I want to set up a target in general for the whole sector. I want to set up a target for this sector, but applicable only to certain countries and so on. So it's fully customizable. And you can also, of course, define which scopes you want to include in your target setting. So here, quite easily. We added scope 1 and scope 2, but depending on the sector, you can of course also add different gas splits and different scopes depending on the data that you have. Also, in regards to the net zero steering, there is normally two types of metrics that you can steer on. So one would be the absolute emissions, and the other one would be the physical intensity. So in this example, we have physical intensity, which is actually something that can be done or that we support also through our asset impact data, which already provides the calculated physical intensity. So if you have this target, you can then also upload asset impact data that can help you steer and check the companies on this particular level. So here we can go then back into our overview of net zero. So you can see how it looks once you have a year-on-year run of your data. So here, probably you guys are familiar with this graph or something similar. This is normally shown in many of the reports. And here we display it based on the data that you run in the engine. So for example, as you can see here, we have some sample data where we have different runs per year. And we also have some future dated information. So we have, okay, 2025, 2026. This is because our solution is quite flexible. So you are also able to ingest data that is future dated. In this case, as it was already explained, with asset impact data, we have physical intensities available, and many of these are already forecasted. So you are also free to upload or integrate that forecasted data into your net zero steering, and that way you will have an overview on how it might look when that forecast happens in the future. So here we have an overview of that. And of course, similar to what we have with finance emissions, we also have an insights section where you can actually have a look at your targets and at the granular level data. So for example, here, let's say I want to look, I'm clicking something else, but let's say I want to look at this cement scenario. In this sample, we have two companies that were linked to this scenario. And here we can see, okay, we are steering for this particular target, but every company has a different metric. So here we can, of course, you can also download this data. You can rank the companies and say, okay, if I were to finance this industry, then with this company, maybe my emissions would be lower, because you can rank depending on their intensities as well. And also, it will give you some insights as to how far or how close you are from achieving your targets, or the reference scenario that you want to compare this particular sector to. So here, for example, it would give you that overview. So you know, okay, maybe I'm closer to reaching my target with this company or not. And of course, this is the granular level view, but we also have the consolidated view. So in this case, we have that here. Yeah, looks like I need to sort again so we can look at the same target. So here we have our consolidated view, where you can actually look at the different scenarios. So each of these rows is the different scenarios that we define here. And here we display the consolidated metrics. And we also display, okay, how many of my financial contracts are linked to each of the metrics, and we give you an overview in case something was not calculated, whether because there is data missing or if there is any error in the input. So yeah, all in all, that's a very quick overview of what our solution can do. And of course, there is, again, also for the net zero use case, many things that we're still planning and that we have on the roadmap. So, for example, we also allow you to steer for not only per specific sector, but you can also steer per building or for physical assets. And that's also something that we have currently coming up in our next releases. So if you want to know more, then we will provide the data so you can reach out.
Thank you very much, Fatima, for this demo. We now have time for some Q&A. I'd like to encourage our audience to put your questions into the chat, which is on your right-hand side. We did receive some questions already. Some people, when they sign up, they've asked us a few things, so we'll try to kick off with those ones. So the first one to Michelle. What do you see being the key benefits in combining the two solutions, SAP Pioneer and Asset Impact?
Yeah, no, I think it's thanks for the question. I think it's a very relevant question. So I think the first thing is that the two solutions are really complementary, and we are a data provider. We provide a lot of valuable data points, but we are not a system provider or solution provider, while SAP Pioneer is really focused on providing the platform to embed data into different processes and different workflows inside the bank. So when we started to discuss already last year with SAP, they were telling us, okay, we are building these modules on net zero targets. We have this module on financed emissions. We are working with banks and financial institutions and talking to potential clients, and we often get feedback on how do my data fit into the system, and some clients also talking about us directly. And on our side, what we see as well is when we talk about our data to potential clients, there are sometimes smaller banks where they are only 1 or 2 persons in the team, and they're like, oh, your data is very cool, but how do I integrate it into my system? Where do I start? What do I do? Or you have sometimes larger banks where they also think, yeah, the data is great, but I already have this and this and that provider, and I would like to switch, but that's a huge effort because I need to switch my system, I need to change my workflow. So how do we solve that? And I think it seemed very natural to combine the strength of the two solutions so that we can offer really an integrated solution to a client who wants to embed asset impact, but also wants something to be basically taken care of in terms of onboarding, that they can benefit from us, the two organizations working together to deliver an integrated solution. So I think for me, that was really the benefit and the logical reason for doing this partnership.
Thank you, Michelle. And in fact, actually, we receive a question that is very much correlated to the beauty of having the two solutions together and how the data really translate into the platform analytics. But it also comes with complications. And the question how, and thank you so much for those who put the question in, is for Stefan, in fact, on how complicated it is to upload the data from different providers into the tool. So you have the data from Asset Impact, but can you do some kind of plug and play? How does it mean to do this harmonization work? They also mention the type of data that we can come at portfolio level, like data also from the PCAF calculation for debt and equity. I would imagine the person who asked this question is from a bank. So I would add to that, and Stefan, sorry if I add complication, but also how long does it take? Because in my experience, there is always this question on the implementation, the timing, and the effort to put and dedicating to that.
Yeah, I have to take that. So firstly, very rightly pointed out in the question, it's always a combination of multiple sources. So on the one hand, you have your bank internal data, and on the other hand, you have external data. And external data can be further broken down into statistical data. That is, for example, emission factors that might come from PCAF, but also other sources, as well as third-party data, such as from asset impact, but also some of the other providers, more traditional, maybe providing reported data, for example. So a lot of what we do in our product is actually harmonizing, having the capacity to harmonize data from those different sources. Now, the question asks, how easy is that? I think the honest answer to that is simply that it's not always very easy. But our approach is that we're saying, look, over time, we want to have the ability for more and more data providers to have this plug-and-play functionality. So asset impact is a great example of that. But there's some of the other larger ones, such as an ISS ESG, for example, where we also provide this out-of-the-box functionality already. Yeah, and then so the harmonization of the external data really depends on whether this relationship is already in place or not. Bank by bank basis. And then for the internal bank data, I would say that we have a pretty strong but also flexible data model that allows you to provide the data in a very structured format and then use that directly for the KPI calculation. And maybe to close off on that, how long does all of that take? It really depends on the approach for the implementation that you're choosing. So some of the banks that we are working with, they want to get started very quickly. They might be calculating for the first time, and then they just deliver the data manually. That is via CSV uploads effectively. And if you choose that route, then it can be very fast. It can be something like, let's say 6 to 8 weeks. On the other hand, we have a lot of banks that say, look, one of the main reasons why I want to move to a solution like Pioneer is because I want to achieve end-to-end automation, and I want to be really robust, and I want to achieve auditability. And that's where we are fully integrating, typically with central risk and finance data warehouse of those banks. The reality of that is, whoever has ever worked on an integration like that, is that typically it just takes some time. So looking at time spans of, I would say, like roughly 6 months here.
Thank you, Stefan. And when we talk about data, in fact, and all the different layers of data or sources of data, Alex, when it comes to benchmarking against corporate disclosure, how do you do that in asset impact data?
Thanks, Maria. This is a question we get a lot, actually, because partly what we're trying to do with our asset-based approach is precisely to provide an alternative or a complement to disclosures. So some of the common issues with disclosures is that they are not comparable. In many cases, they're not complete, such that private companies or companies that are potentially listed but not on stock exchanges that require certain things, or in jurisdictions that require certain things, don't necessarily provide all of the data points. Having said that, whenever we refresh our full database, which happens 4 times a year, we conduct an extensive benchmarking exercise, particularly for the largest companies for which disclosures are most complete, to make sure that we are comparing like for like. So it is actually an expected feature of our data that you would see differences between what a company would say its, say, scope 1 emissions are and what our data says. But it's not because the underlying data is necessarily different. It could be on the basis of exactly the same assets, but they're being accounted for in different ways. So this is why I referred to it earlier, but we provide different consolidation methodologies, some based on, well, one based on financial control over the assets, the other based on equity ownership weighting. And that's because different institutions, as well as different companies in different sectors, prefer to use one or the other, or some combination of the two. So to conclude, we do conduct extensive benchmarking against company disclosures. Most of the questions we get from our clients relate to this. We're constantly reviewing and conducting reconciliation exercises, but it is also a feature, not a bug of the system, that you do see differences.
Great. So that's when we look at data company by company level. But what about portfolio level coverage? What is your portfolio level coverage from a data point of view? Alex, to you.
Yeah, thank you. It really depends on the metric in question. So if you're looking at the number of companies covered versus, for example, an index, we would not have full coverage because we focus on high emission sectors. But on the other hand, if you're looking at the share of emissions underlying that portfolio that we do cover in our data, it's routinely above 90%, sometimes above 95%, depending on the composition of that portfolio and whether it has significant exposures to the high emission sectors that we cover. So again, it's an expectation that in terms of just the number of companies, we'd not expect to have 100% coverage because we're not covering, for example, segments like tech and services and financial services and so on. But in terms of the underlying transition risk and the emissions, we'd be confident that for almost any diversified portfolio, we would cover the vast majority of the underlying emissions and activities.
And if we take that consideration, moving a bit broader from a financial institution, Stefan, and then we look at the solution, what are the other sectors that the solution can cover as well?
Yeah, so on the finance side, we are fully agnostic in that sense. So meaning a bank can essentially achieve full portfolio coverage. For the finance emissions side, we're following the PCAF standard, and we cover essentially all of the asset classes that are also covered under PCAF. But we also go beyond that. Should the bank have specific calculation methods for a specific sector, for example. But to give you a concrete example, one of the common sectors where also a lot of banks would have set net zero targets is, for example, real estate, so residential real estate as well as commercial real estate. The calculation logic here works slightly different because we always look at the individual buildings that you're financing. One building might have multiple EPC certificates, so we have the full granularity there to essentially go down to every single building unit and then again attribute that back to the financing level and then roll it up to the portfolio level, so you have the whole view of the net zero alignment there. So to cut it short, you can achieve full portfolio coverage through a combination of, on the one hand, using asset impact data for the high emitting sectors, but then also using other data sources as well as bank internal data for the remaining sectors.
Thank you, Stefan. So we're almost approaching the end of the webinar. I will continue to encourage you to send your questions through our chat. And maybe let me just do a final round to Stefan, Alex, and Michelle before we conclude. So Stefan, since I have you, obviously the natural question is, what is your relationship with SAP and the use of the technology? What is the type of prerequisite that users should have for the solution?
Yeah, so Fine is a spin-off of SAP, meaning we are the former financial services arm of SAP, and we are home to all of the bank and insurance-specific products. When it comes to the ESG solution, it's actually one of the few cloud-native solutions, meaning there is absolutely no technology prerequisites when it comes to the use of SAP, ERP, and so on and so on. It's of course always helpful. It makes things easier in terms of getting started, but we're fully flexible there.
Brilliant. And Alex, a question that just came in on how do you build your forecast before then leaving the last word to Michelle on the conclusion.
Thank you. I'll be very, very brief because it's quite a complicated topic, but at a high level, we effectively forecast underlying asset level activities at the asset level. We do so on a sectoral basis that's also broken down into different assumptions and parameters for different kinds of assets based on what they are, where they are, how old they are, etc. And in some sectors, our forecasts are extremely sophisticated, such as the oil and gas sector. And in others, they are more static, but in general, that reflects sectors where asset utilization, for example, tends to be at or very close to 100%. So in the absence of changes to the underlying technology, you would not expect to see too much difference in either the use of the assets or their emissions, such as the cement and steel sectors, for example. But yeah, I'm very happy to go into further detail for anyone who's really interested in diving in, but at a high level, that's how we do it.
Michelle, what do you want to add on the partnership and the solution that you're offering?
No, I mean, nothing. I think we've already presented a lot. We're obviously very excited to have this partnership in place, and we believe it can really bring value to financial institutions in having a kind of integrated workflow, which is what is required, as we mentioned today, to move from really just measuring and reporting into taking action. So I think it's it's really exciting, and we're looking forward to help clients on that journey. Maybe my concluding word would be what to do if you're interested to know more, and in that sense, if you're an existing asset impact customer and you want to know more about the SAP Pioneer solution, feel free to reach out to your account manager at Asset Impact. And the same way, if you're a Pioneer client and you want to know how that plug and play data integration can work, you feel free to reach out to your Pioneer representative. And if you're new to both solutions and you're here today and want to know more, I mean, you can obviously reach out to Stefan or myself, and we'll be happy to make more insight, to give you more insights and make a customized demo. And we're already working on some POCs for some potential clients with Stefan. So we're happy to get in contact with the banks.
Brilliant. So I just wanted to say a big thank you to Fatima, Stefan, Alex, and Michelle. Just mentioning that this webinar has been recorded, so you are going to be receiving a recording. Also, our contacts and contact email if you wanted to send more questions or you want to reach out. So with that, thank you very much to our presenters, and hope to see more from the audience, and hope to get in touch. Thank you so much.
Thank you, Maya. Thank you, everyone.
Thank you.
Thank you.